And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Luke Smith, good afternoon.
Good afternoon.
As promised, we're going to talk today about the difference between deductible and non-deductible contributions. But before we do, the hot topic in the news from the finance perspective in the last few days has been the Labor federal government's plan to tax unrealised gains inside your superannuation if you exceed the $3 million threshold. Now, Luke, as you've pointed out previously, most of us are not going to exceed that threshold. That's not the issue.
No.
The issue is the principle of taxing unrealised gains, which could well force people to sell when they don't wish to sell because there's no other way to pay the tax. It's just, it's one of those things that is considered to be, downright wrong.
Yeah, look, I think anybody that can put this forward and anybody that could vote to think that would be a better piece of legislation that could help this country is living on another planet, as far as I can turn. I don't have a problem with people amassing assets and paying an additional amount of earnings tax on a threshold like over 3 million. Okay, everybody's got to pay a little bit of something, and again, nobody likes these things, but to tax something that hasn't actually occurred I think it's one of the most deplorable things put forward in a long time. And
while the current policy is likely to impact on only a very small percentage of the population, if the threshold stays the same over time, more and more people will reach that threshold and become affected. But the other concern that really has people alarmed is that if the government can get away with this, then they might try the same thing in other contexts and find other ways to impose tax on unrealised gains.
Completely, and they're the conversations that people are having with me in the office in relation to, well, where does it go? Because you've got whole areas of the community or portions of the community where, take your farming environment. Here's a great example everybody uses. Massively asset rich, generally cash flow poor.
Yes.
Now, if you start taxing the value of a farm inside a super fund where you have limited cash flow, you're then going to force the generational transfer of asset through sale or limit the ability for families to continue a tradition that they may have had for, hundreds and hundreds of years. I can't get my head around. I can understand paying tax on earnings and paying an additional 15% over 3 million. Okay, cool, no dramas, moving on. The unrealised side of things, it blows my mind.
Yeah, that's taxing a profit that you haven't made.
And you've seen and as we were discussing off air, land tax is similar, right?
That's right.
You're taxing somebody for the land value of an asset that they haven't disposed of or seen any gain because they haven't used it.
They haven't sold it
for their own improvement. Exactly. I can't literally. I'm speaking. Anyone that knows me, that's tough. And the fact that someone could put this forward just shows the horrible road we are going down from a parliamentary perspective at the moment.
All right, so unrealised gains, the government wants to tax them. We need to vigorously protest that in order to discourage them from incorporating that part of their policy. Meanwhile, back to our topic for today. As promised last week, it's a simple one today, but we've spoken so many times about making contributions to superannuation, and we always have to make the distinction that it's either a deductible or a non-deductible contribution. But what is actually the difference?
Right, so in its simplest form, am I not getting a tax deduction for the money going into super? So a lot of people know about the 30,000 limit, which was 27,500 last year, and it's indexed over time, and that's the most you can put into super and claim a tax deduction. Now that $30,000 threshold includes multiple sources. One, obviously, work. So you get superannuation guarantee from your work, that counts. If you put in your own money and claim a tax deduction, which is known as a personal deductible contribution, it's personal because you've used your own money, you need to notify the fund through a form that is called a notice of intent. Now, that form is vital because no form, no deduction. And what it does is it tells the fund that's received the money, hey, I'm going to claim a deduction for this, so you need to remit the 15% contributions tax that is payable on it. The other part that people need to keep in mind is, what do they need to do So that's deductible. Non-deductible is, wow, I've got this money that just fell out of the sky and I'd like to add it to my superannuation for a range of reasons. One of them might be, well, I'm 59 and my mum's just passed and I've inherited some money, or I've sold an asset that mum had and I want to put some of that into superannuation, but I actually don't need a tax deduction. That's called a non-concessional contribution, where no deduction is claimed. So we can swap out the word concessional for deductible. It means exactly the same thing. A non-concessional contribution, a lot of people forget about. They all know about the 30 and then they go, well, I can't put in any more money. And I go, well, yeah, you can. You just don't get a deduction. And again, not a bad thing. That limit is $120,000 a year, or you can do a one-off $360,000 contribution, which is 3 times the annual limit if you had a big block of money. Now, if you do go down that road, we spoke last week about the total super balance. You need to see how close you are to the threshold in relation to total super balance. So don't assume that just because you're able to put in $360,000 that you are eligible as an individual. You need to check your total super balance. For that, check last week's show. But if you do put it in, it's for the year that you put it in and you're locked out for the next 2. Because as I said before, $120,000 a year or $360 in one go is 3 times the annual limit.
Yeah, effectively you're putting in 3 years just in one hit.
Exactly right. So you can put that in. Now, with a deductible contribution, you can get some tax benefit. The limit is $30,000. You can also use what's called the catch-up legislation that says you can go back at the moment to 2020 financial year and see what you haven't used of each financial year's limit. So this year's 30, the last few years have been 27,500, and then in 2020 the limit was 25,000. So you go into MyGov, if you've got super tied up in MyGov, you can see the limits, or you can call your fund and say, hey, what did I put in for each of those years? And let's say you were $10,000 short in each of those years because all you did was get super guarantee. You might have $50,000 or $60,000 of space. So you can put that into super and claim $50,000 or $60,000 as a tax deduction. Why would you do that?
Well, to reduce your tax bill.
True. But you may have sold an investment property. You may have a large capital gain that you want to reduce. You may not be working. You can still make a deductible contribution because under 67, you don't need to meet a work test. So if you sold a property and you had a large capital gain, it would make a lot of sense to put $30,000 into super at 15% because that may be less than your personal marginal tax rate as a result of the capital gains on the sale of the asset. So there are a range of reasons that you would make a contribution. You can also make a contribution over the age of 67. You just need to work 40 hours in a 30-day period in the year that you do the contribution. So big misconception I get from people is, well, I don't work anymore, I can't do that. That's not the right question to ask. The right question to ask is, do I need a deduction and am I over or under 67? Because if you're under, go your hardest. Now, we spoke last week about total super balance. Total super balance affects a non-concessional contribution where no deduction is claimed. And as I pointed out last week, you can be over the total super balance and still make a $30,000 deductible contribution. So again, let's not assume I've hit that limit, I can't put any money in. You just can't make a non-concessional contribution. You can keep putting in $30,000 and getting a deduction where that's appropriate for you, no problems whatsoever. In relation to the non-concessional contributions, there is no additional paperwork that needs to be lodged. With the deductible contribution, we have to put in the notice of intent. People ask me often, well, if I make a non-concessional contribution, what do I fill out? There's nothing to fill out because all super funds will treat a personal contribution as being non-concessional or not entitled to a deduction unless you tell them, which is why we need the notice on this side. So you can put in $360,000 provided that you're under the limits. That can go into superannuation, you pay no tax, you could start a pension, and that creates a tax-free component inside your super. Now, one of the best shows we've ever done was reducing the estate tax for children, and everybody wants to understand the recontribution strategy that I've explained for people over 60 that have retired, because it removes the 17% tax that non-dependents incur when you pass superannuation to them on your death. Now, don't worry, because a lot of people say, but if I put in a non-concessional contribution, aren't I creating a tax problem? No, because it goes in tax-free. It's treated as tax-free inside the fund. Okay, so it's a great way for you to use a non-concessional contribution as part of inheritance, savings, sale of an asset, add the money to superannuation, think about using multiple funds to control the taxable components, start a pension when the money goes in, you lock the tax-free status of that money for perpetuity, and you don't have an estate issue for your children. So the non-concessional rules are very, very flexible. Another thing people need to keep in mind is that they don't, I had this one this week actually, it quite surprised me. Does one offset the other? So if I do $30,000 of deductions, does that mean I have 70,000 of, 80,000 of non-concessional space? No. One doesn't offset. They're completely separate tests. So you could put 30,000 on the left and claim a deduction. You could put 120 on the right, not claim a deduction. 150,000 into super, no dramas. They don't offset each other. The other thing is you can also use non-concessional contributions in conjunction with downsizer, in conjunction with CGT, small business concession. So again, they don't offset anyone else because they are their own independent test. So don't assume because you do one, you miss out on others, depending on your broader strategy.
That's why you talk about strategy stacking.
Yes, correct.
You can stack one strategy on another, on another, on another.
Correct.
For as far as you like. So very simply today, the difference between deductible and non-deductible is you can claim a tax deduction for the deductible contributions.
Correct.
And the other kind you can't.
Correct.
That's as simple as that.
Hard as it gets. Exactly right.
We like to keep things simple around here. Luke Smith from Envision Financial is with me today, and we're talking about the difference between deductible and non-deductible contributions to your superannuation. And while that is the actual definitional difference, the rules for each are a little bit more intricate, and that's why we're having the conversation. So, Luke, we've reached the point where it's time for me to ask you what are the key things for people to remember when making the choice of what sort of contribution they would like to make to their super.
Yeah, so first off, think about what you're trying to achieve. Why am I doing it? Am I doing it to add capital? Am I doing it to rebalance the taxable components? Am I doing it to add money to my spouse's super before he or she starts a pension? Am I doing it to try and get money out of my own name to lower my tax rate? There's a range of reasons why you would put the money in. Do I want to reduce the capital gain on the sale of a property? They're all very valid reasons. So you need to work out why am I doing it, then come to what type of contribution am I going to make. Deductible contribution allows you to claim a tax deduction. That's advantageous from a marginal tax rate perspective because where your income tax rate is more than 15%, you're deriving a benefit because you pay 15 going into super up to 250,000. But if your marginal tax rate's 39 cents in the dollar, you're better off because you get a refund at the end of the year, got some money back, put in your offset account, give it to the kids, whatever you want to do with it. In relation to adding money, a non-concessional contribution does not get you a tax deduction, but it does allow you to put already potentially taxed money into super without incurring any additional tax, which is a great thing. That could be an inheritance, that could be the sale of a property, it could be from a range of sources. You want to think about where you're going to put it. You want to think about how you can put it in. You want to think about the limits that you need to consider and then refer back to our total super balance discussion from last week because that will impact your capacity to use up to $360,000 depending on the balance of your super at the previous 30 June line in the sand. So again, don't race out and go, oh, I can do 360, throw it in. If you've got 1.9 million in super, you've got a massive problem. If you've got 1.8 million in super, you've got a massive problem because you're not eligible for the full 360,000. Think about the fund you want to put it in. So you don't necessarily want to put all of this into one fund, depending on the type of fund that you maintain, because you could be creating a difficult tax position for your children, and a strategy to fix that we've discussed in the past with a recontribution. But if you can separate the contributions, I have no problems with somebody having a fund for their deductible contributions and a fund for their non-concessional contributions, where you can start a pension. You're over 60 and you can control and lock the tax treatment of that money. Be strategic about where you put it. And as we said in previous shows, don't just assume that having one fund is the best way to do it, because there is massive value generationally from being a little bit more strategic about the tax profile of your broader super.
Fantastic. So deductible, you can get a tax deduction.
Yep.
Non-deductible, you can't.
Correct.
It's as simple as that.
That's all we need on a Friday afternoon.
Indeed. But I guess the other thing to take out of it is that there are caps on how much you can put in for each kind of contribution.
Correct.
But they're different caps.
Correct.
And, of course, once you've put the non-deductibles in there, you've got to think about, are you putting in 1 year, 2 years, 3 years all in one go, whatever the case might be. But I guess the most important thing to remember, if it's a deductible contribution, you need to also submit the notice of intent to your super fund.
That one.
Otherwise, you'll miss out on your tax deduction.
That one I stress over and over and over again, because no form, no deduction. As I said before the ad break, a super fund will treat any money from you personally as a non-concessional contribution by default. So you put in your 30, you lodge your notice of intent. The fund will write back to you and say, hey, Leon, thanks for that money. Keep that communication, because generally your accountant's going to want to see it.
Indeed. All right, Luke, it's time to say, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. It's Envision with an E. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. And we've got YouTube. We've got Envision Financial Canberra, where you can subscribe and get a back catalogue of all of the shows. And all of these types of legalities and strategies are in Smart Money Strategy, your ultimate guide to financial planning, in all and good and bad bookstores.
Yes, in all bookstores, good and bad. Luke, thanks very much for dropping by today. All being well, we'll do it again next week.
We'll have a go. Thanks, mate.
Indeed, thanks very much. Luke Smith from Envision Financial, back with us again at the same time next Friday afternoon to talk financial matters once again.